The S&P 500 closed almost 6 points higher today in a day with volume and trading ranges that made it look like we either had a half day of trading or it was some kind of holiday, which was neither. So we are seeing very typical behavior as we head into what could be a short-term resistance. I'm going to break down our expectations for that in tonight's video. I'm also going to show you an area of for a trade idea, in an area that showed some relative strength on one hand, but some weakness lately. It might be providing us an opportunity for a decently bullish trade. So let's go ahead and get started. Today is Wednesday, January the 16th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off like we always do, taking a look at the market forecast indicator on the S&P 500. Now, you'll notice we still are bullish, right? We got dark green shading. Now, you notice we got dark green shading. Well, this is on the Russell. We got dark green shading here without a green moving average. So keep that in mind. We're not back up the truck bullish, as if we ever are truly back up the truck bullish. But we're not strongly bullish here because we don't have that rising moving average, which is typically what you get when you start the intermediate trends. We can get dark green within these little pullbacks, right? And that's what in fact, we got some here in November and then in December, at the beginning of December, but the trends didn't change, and the same thing could be happening right now. In fact, I still fully expect that we will reach 2,500 before we reach 2,700 on the S&P. It doesn't mean that it can't happen. It doesn't mean that headlines can't come out and push us up through, but I expect at least 25, 30, 30, if not into 2,500. I expect that area to be touched first before we hit 2,700 or beyond, which will mean, probably on the next near-term pullback, when the near-term line pulls back down below the 50th percentile. You notice we've got 1, 2, 3, 4, 5, 6, 7, 8 days now where the near-term line has been above 50, coming up off of this bullish near-term low point. Obviously, we're at a higher high point, and that's where the old high point is where that pullback can come down towards. So very, very easy. It'd be very easy for it to do that. You'll see here as well in a few minutes when we took a look at the intraday chart. The momentum line fell today, but it didn't fall when it falls down here, that's when you get concerned, especially when it gets below the 5th percentile. That's when you get concerned about the potential for more of a bearish trend, especially considering that we're at the 50-day moving average right now, and we haven't tested the 50-day moving average yet. We're in the process of it. That's why today's range and today's volume was so very light. So there's not a lot of people willing to buy yet because we haven't really pulled back from the 50, right? We got to test that 50, pull back, get a higher near-term low point, and then push your way through. That's typically how these work. And then, of course, you got the 200-day moving average looming up above that. So, as is typical when you're heading into a resistance level, trading ranges get smaller, volumes get smaller, as we saw today. Near-term lines getting very mature. 8 days. Now, that's not mature in a normal bullish trend, but it is mature for a trend, for a weak bullish trend like we had when this started. So it's a very, very mature near-term run, and what was when it started a weak bullish posture, and like I said, still is relatively weak. Even if the intermediate line is crossed up above 50, it's still relatively weak because we don't have the green moving average line. See, when you got the crossover over here above 50, no green line, right? We got the crossover here above 50, no green line. When you got the crossover over here above 50, okay, now at that point we did have a green line. And the same thing over here, we did have a green line at that point when you got these crossovers above 50. So we don't have the green line, which represents, again, very visually on this chart, it represents that we are above a rising 6-week moving average. So we don't quite have that yet. And you see that's the case for all these averages. The Dow shows the same pattern. The NASDAQ composite shows the same pattern. And the Russell that we were looking at initially also shows the same pattern. They're all bullish, but not as strongly bullish as they could be because we don't have the rising 6-week moving average quite yet. And all these indexes approaching, relatively mature. In this case, on the near term, on the Russell 2000, it's been above 50 for one, because the pullback didn't get you below 50 here. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. That's 14 days, which is mature for a strongly bullish market. 14 days without a near-term pullback. Much less a market coming off of what was, a cluster of a rare, very, very rare cluster of clusters. And not rare that you got a cluster of clusters, it didn't happen, but it's rare to get that many so consecutively. It was rare to get that, much less what we got around Christmas, which again just shows how rare an opportunity it is, this pullback that we've had, that by the end of this next year, we might be looking at and saying how grateful we were for this type of opportunity, because we wouldn't have got it. We wouldn't have had, again, assuming you get the kind of returns that's typical coming off of these kind of lows a year later from now, we wouldn't have got those kind of returns if we would have been trading, say, up in this area at the end of the year, where we'd have been very mature, bullish, similar to how we traded at the end of 2017, where going into 2018 we were already very maturely bullish, and then we had that extended run in January that made it even worse. And of course the returns for 2018 was one of the few years it's negative. So now we don't have that. We've had such a pullback here. The potential returns for 2019 increased. The odds for good returns increased, not to 100% of course, but the odds for really good returns in 2019 increased because of how rare and how deep these pullbacks were at the end of 2018. You can see here that we're on the long-term chart that we are testing that 50-day moving average. We're a little bit above it. Now remember, this is the 10-week exponential moving average, so a proxy for the 50-day that we use a little bit. The actual 50-day simple moving average, we're trading right within a hair of it right now. So we're testing where we typically get resistance, right? We typically, when we come up towards the 50, we typically hit resistance. Now we typically bounce off of it to new lower lows. Now in this particular case, we went so far below it that that's not the likelihood this time. It can happen, but not the likelihood. But it doesn't mean that we can't get down towards this 2,500. Like I said, more likely we'll hit 2,500 before we hit 2,700, which I do fully expect us to do eventually. Of course, the crossover, the golden cross, we're still multiple weeks away from what would be a golden cross. And again, that's going to be after we get the successive low point, whenever and however deep and however long it takes to get it, and then that subsequent bounce up to the 200-day moving average, and then potentially through it, right? That's kind of the next stages. If you take a look, at the 3 green arrow chart, we got the 1 green arrow. We actually got all 3 green arrows, but again, we don't have the rising moving average, which makes a big difference here in terms of our expectations going forward, in terms of how bullish we are. We break these lines down on a 3-line basis. We almost got the 8 and the 8 and the 17 crossing. Again, it's usually you want the crossover of the 8 and the 17 to pretty much align with both lines crossing the 30. We don't have that right now, so that suggests we could get more of a pullback and let those lines converge a little bit more before you get the crossover the 8 above the 17 and both lines crossing above the 30, which is the typical type of a move. And then we get the move to the extreme highs to the upside. So we'll see if that ends up being the case this go around as well. Alright, so today we had very, very light volume. You can see, look at the trading range. Really extremely low trading range. Very, very low volume. A lot of trading here at the end after the no confidence vote came through, but it didn't really make much of a difference in terms of the gap. Again, like I've mentioned before, the trading range, including about a quarter point of a gap. I mean, not much of a gap. The close was at 260.35. Today's low was at 260.60. So about a quarter point of a gap. So you're looking at, still less than 1 3/4 point move here. Less than 1 2/3 point move on an average range of 5 points. So, and then the volume, like I said, 77 million. Let's put this in the context here. 77 million, still very, very low. 1 3/4 points is very, very low. Starting to bring that line back down below 2%. So it just means that the correction, the strong selling is over. The correction's not over until we get, the bullish trend hasn't started until we get back below 1%. That's usually kind of the sign that, okay, we got this bullish trend going again. And it can, they can start, the intermediate trend can start, but we really feel much better once we get that average, the ATR, to drop below 1%, which, remember, for, right where we're at right now, it would have to be about 2 3/4 points. It would have to drop all the way down to here. And while it's dropping here from these high levels, that still creates the environment for that second retest, that pullback. And again, right around, doesn't have to be too deep this time because this dropped so deep. So we're looking right around 250, maybe a little bit smaller, less than that. Then you look at the volatility index here. The volatility still relatively high levels, high teens. I saw a tweet today that said that the lowest point that we've had so far this year is still higher than every single print it had in 2017. So it just kind of shows how much of an anomaly 2017 was, and how we should really discount it when we're considering what are the expectations for how volatility behaves. You notice we're still in the bearish zone. So we're still above 95%. We're still in the bearish zone for volatility. We're probably going to flirt again with this 20, maybe a little bit above 20 on any kind of near-term pullback that we get, which will probably bring this up. I do not expect any rise in volatility to get above that 105% this go around, but we can definitely get above 1% and approach that area on the near-term pullbacks, and then that would be a great selling opportunity for volatility if you trade options to be able to take advantage of that if and when it does occur. So to summarize, the markets continue to be bullish, but it's running out of gas, right? We're kind of running on fumes here, at least not in the long term, but in the short term, running on fumes, excuse me. And so we're approaching, which is typical when you approach resistance. In this case, it's short-term resistance. We're not looking for any big bounce back. The tone of the markets will be, when we do start to pull back, we'll see this is a bear trap, and so you'll get a lot of that when we start to pull down. But just remember, it will be very typical behavior for this type of market that we're in that has in the past led to decent runs. Doesn't have to, of course anything can happen, but we've seen this kind of behavior in the past. And as I mentioned, when we start getting the short-term pullbacks, you will see a lot of chatter about this being a bear trap, and see the bulls have run out and they're not there anymore, and here we go, a la fall 2008, which, remember, those kind of moves don't usually start bear markets, they usually end them. And if we are starting a bear market, we're barely in the very initial stages of it. So keep that in mind. And usually doesn't occur until after we retest the 200-day moving average, which we haven't yet. So what do you think? Do you agree with that assessment, or do you disagree with that? Click that poll popping out in the top right corner of your screen, then hit either agree or disagree. If you click disagree, scroll to the bottom, comment down below on what you see that would suggest otherwise from what we surmised here going through our market outlook routine. As always, remember to subscribe to our YouTube channel. There's a red button that's popping out here that in the bottom right corner of your screen. No, excuse me, you have to mouse over the logo in the bottom right corner of your screen, then hit that red subscribe button that pops out. That will notify you when these videos are posted on YouTube. Also, click the thumbs up icon down below the video. That tells me that you want us to do the video again. Again, the worst thing you can do, even clicking the thumbs down, actually promotes us on YouTube, because it's an engagement, and the more engagement these videos have, the more YouTube will promote the videos to people who like this kind of content. So really the worst thing you can do while you're watching these videos, if you don't want us to do these, is don't click on anything. Don't click the thumbs up or the thumbs down, because that lack of engagement is what will tell YouTube that they shouldn't promote it. So clicking the thumbs up lets me know, clicking anything lets YouTube know this is an engaging piece of content. Clicking the thumbs up lets me know you want us to do the video again, day after day after day. Really quick and easy way to do that. One click is all it's needed. Also, comment down below on what you got out of it. I love to hear what you're getting out of these videos, what you learned, what you didn't know otherwise, or what you remembered because of what we talked about. As well as you can also post comments or questions for me down below too. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click that link up there to subscribe. Follow me on Twitter for more content like this throughout the day. Join our Market Outlook community that we created on Facebook. Now, before we look at what's driving the market action and get into today's trade idea, a reminder that you can also like our Market Outlook tweet and Facebook posts. Again, not clicking on anything is the worst thing that you can do for us, because the more you like the tweets, by clicking on the like. The more you like the Facebook post, you can click on here, that will take you there. The more Twitter and Facebook will promote this content because of the engagement that you're providing. So it also tells them that you want them to make sure that you're seeing all of our stuff because you're engaging with it. And it tells us, like I said, that you liked our content, you want us to do it again. So really here are 3 clicks. 1, 2, and then 3 here on the blog by clicking on this like button, just like that. Also remember our calendar for upcoming classes over here to the right. We have Brandon's weekly Q&A session, so make sure you check that out for those that are premium subscribers. I've got my portfolio management class and my Friday technical analysis class that we do that usually wraps up the end of the week. Also, there's a link right above the video where you can participate with other market scholars in our Market Outlook forum. Questions, comments, anything you want to share, that's the place to do that. You can do that for free by subscribing to our site by clicking on this logo up here. Alright, when you take a look at what's driving price action today, you can see the biggest winners today were the emerging markets. They really rallied hard. Developed markets lagging behind, of course, a lot of influence there with what's going on over in Great Britain. But emerging markets really doing well. We'll take a look at that here more in a second. Small cap stocks outpacing large cap stocks. Crude oil making a run by the end of the day and outpacing gold. Gold here in red. So crude oil started the day down, finished the day higher. So a good, a lot of risk appetite moves. Now very, very small moves. Emerging markets, you only want to get above 1%. Everything else, and really crude oil was up 0.5% because it's always the most volatile, and small cap stocks finished with a decent gain. Everything else really, really flat. So again, we are running out of gas into short-term resistance, and that's very, very typical behavior after the kind of runs that we've gotten. Growth stocks small, a little bit of a small loss, but everything else up. Even the bonds were up a smidgen. Corporate bonds were up. Investment grade outpacing corporate, so that's a little bit of a risk off relationship, but not that big of a gap there to really worry about. And then you can see, like I said, emerging markets, value stocks. Well, it looks like the return's not up there. Real estate stocks, up doing, has a really good return today. Real returns, right? Commodities, these are all real assets, tangible. So they had a good run, while paper assets kind of running out of, like I said, running out of steam. Let's take a look at the international markets here. As I mentioned, those emerging markets really have done well today. Let's show which ones here. Let's get to the foreign markets here, and you can see Korea, China, and Russia all doing well. Italy, the emerging market of Europe, also doing well. You can see India outpacing Japan. So all these, Korea and India outpacing the developed market over there in Asia. And then Canada outpacing the U.S. a little bit. On the other end of the spectrum, not surprising, UK with the biggest loss, but not really that big of a loss. Brazil pulling back a little bit too, but it's got the biggest gain, so it's got the biggest outperformance right now. So a little bit of room to give up. And in fact, you can see all of them look very similar to the S&P. The only difference is India's had a rising moving average and will again tomorrow with the bounce back up we've had today. And Brazil's got a rising moving average. Everything else looks very similar to the U.S., which remember how these areas had diverged from what the U.S. had been doing all throughout last year. Now there's a lot of convergence going on. They all look very, very similar. And as we've been rallying, it's the emerging markets that have been rallying the most. So if we do indeed turn up here, you can see even China up over the last 3 months, 1.5%. So outpacing over the last 3 months. Here's our biggest winners over the last 3 months. You have India. Let me just make sure I've got these numbers. I've got the right time frame set in here. Yep. So you got India there. You have China. There's China. There's India. There's Brazil with a decent return. All emerging markets. And then on the other end of the spectrum, you have the U.S. stock market, but then developed international markets with the bigger losses. So they're struggling the most. There's a little bit of a move to emerging, which is a good sign and a very typical pattern when you see weakness in the U.S. dollar. So if I were to show a one-year chart here of the U.S. dollar, you can see we've got a red moving average. We've got dark pink shading. It's light green now, but not until, again, we get the dark green with the green moving average are we back to being bullish again. So we're just less bearish now than we were before. Since we are smack dab in the earnings season, and financials having the best performance today, not surprisingly, up over 2%. Everything else very, very flat. Real estate stocks are doing better. You can see the performance outperforming the broad market for most of the, well, by the end of the day. On the other end of the spectrum, consumer stocks really struggled. So you have communication services, you have staples, you have discretionary, all lagging and suffering the biggest losses. But, again, context on those. They are, here's your biggest losers down here at the bottom. You can see the biggest losers over the last 3 months have been technology, industrials, and energy. In fact, those are the only 3 that have underperformed the markets. Real estate and utilities have outperformed along with staples. So that's obviously representative of kind of more of a bearish market. So you'll start to see a kind of a flip-flop here. But not until after we see some weakness in some of these cyclical areas in the short term. If you go back to, as I mentioned before, go back to the, in fact I have to go on this chart again, to go back to that Christmas low point here to what we're seeing right now. And let me update this chart to get today's data on here. There we go. So zoom in on the low point that we had in the markets, and then going forward, and you can see energy stocks, communication services, discretionary, they've had the biggest gains. Financials too now, with some strong, this late push here with the earnings today. They're going to pull back some during this any kind of near-term pullback, because they have the most to pull back. They have the biggest gains to give back versus, say, somebody like utilities or even real estate that haven't bounced up nearly as much. So they will hold their value better during any kind of short-term weakness. Now you notice real estate has done relatively well today. One of these stocks, you can see Lowe's here, related to the real estate market. It's had a little bit of a pullback. There's been some weakness in consumer stocks, but some strength in real estate, and relative increase relatively small increase in the housing market index, the home builder sentiment. So there's a possibility and that stocks like Lowe's or Home Depot can rally, and it's as you can see, it's not been on a bullish trend. You've had a nice good run. You have dark green shading, you have a green line. We're pulling back right now in the near term. It's pulled back a little bit, but you have the opportunity here for a intermediate confirmation signal. Yeah, we're a little deep on the pullback. We're a little deep on the near term line. Again, I think a lot of that has to do with relative weakness in the sector, in the consumer sectors. But I think we have an opportunity for a trend trade to develop from here. If you take a look at the 3 green arrow chart for Lowe's, you've got the 1 red arrow here, and what does that look like? Well, look at the here, right? Here we go. You can see what that 1 red arrow looks like is, and here's the crossover of the 30. This is what I'm expecting on the S&P, right? The crossover of the 8 over the 17 at the same time that both cross the 30. So that's actually a good sign. We pulled back to the 17-day moving average. There's your red arrow. So at least it's still positive. And stochastics is down below its moving average. We have some short-term weakness here, but I believe there's an opportunity here to take advantage and potentially buy a bounce on this. And we can do that by looking, at these March options, 58 days out, and looking to buy an at-the-money option, and we'll look at the 95. Now, the benefit of doing an option trade on this is if it does pull back down and turn into more than the short-term weakness, then we can limit our losses to half of $370. So what would that be? 190, 165, 160? No. 185. Couldn't do math in my head for some odd reason. $185. So that'd be no big deal, right? And you can see if I were to analyze this trade, we'll analyze this and throw this into a single symbol. There we go, and move this down. So for us to get right now, we'll set slices to break even. So it has to move up to get us to, by expiration. But for us to get to, right now to lose $170, we'd have to fall all the way down here below $90. So we'd have to fall below this area and really kind of nullify this turnaround that we're getting. So we've got some room that we can pull back and maintain small losses. But if it does make a run up higher, make a run up to 100, there's going to be some resistance up in this area. You can see on this chart, on the Bollinger Bands chart, you're going to have some resistance up in this 100 area where the top end of the volume band is. then you notice here that we'll get about a $343 a gain, or roughly 100% return, or excuse me, twice the return of the risk that we're trying to get. And this would be profits, right? So we can get a decent 2-to-1 profit to loss ratio if it does hit up into this area of resistance without getting too far, without breaking below these old high points on the way down that we had just barely broken above over the past couple of weeks. Okay, well, that wraps us up for today. Now I want to hear from you. What do you think about what we talked about in today's video about this market outlook? Do you have any questions or comments for me? Post those down in our Market Outlook forum. There's that link I showed you earlier in the video above, in our blog above the video that you can click on right now. Remember, you have to subscribe to participate there. There was also that link that popped out in the top right corner of this video that you can still get to if you click that little eye up there. It will open up, and just scroll down and you'll find the link that will take you straight to our Market Outlook forums. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, click that thumbs up icon, and comment down below. Also, remember to follow me on Twitter for more content like this in between videos, and join our community, our Facebook community that we created with over 1,000 of you that watch these videos day in and day out. So again, thanks. Have a great rest of your evening, everybody, and we'll see you all tomorrow.